In a world overflowing with answers, we pause to ask the next question. Welcome to the space where curiosity meets consciousness, where AI evolution and the environment collide with thought. This is the next question.
Welcome back to the Deep Dive. This is where we take that stack of sources you send us, articles, notes, research, and, well, we dig in. We pull out the key insights, the useful bits, basically giving you a shortcut to getting properly informed on complex topics. And today, we're tackling a really big one. It's buzzing around Wall Street, everywhere. Can AI actually predict the next market crash? The sources we have offer a pretty fascinating view on this, especially looking at it from the angle of Indian retail investors. Now, it feels like a major shift. Markets used to run on, let's face it, human greed and fear. Simple as that almost, but now it seems like it's all about algorithms and data. So the huge question is, could AI, really see something like 2008 coming, that whole boom to doom scenario? Could it have given us a heads up before things went south? That's what we want to unpack today.
It really is a fundamental change. Think about the old days. Investing was about what they called shoe leather research. You'd literally go to malls, check out crowds, try to get a feel for the economy on the ground.
Right, that hands-on approach?
Exactly. Today, though, the landscape is just dominated by machine learning, deep learning, what some call fast learning, because these systems adapt so quickly to, well, new information. Now, look, AI isn't some perfect crystal ball for every little dip, but its core strength, its pattern detection on a massive scale.
Yeah.
Think of it like a digital detective. It can sift through trillions, literally trillions of data points, tweets, trades, news headlines, economic reports.
Stuff no human team could ever process.
Not in milliseconds, anyway. It finds these tiny correlations, these anomalies that are often invisible to us.
So less crystal ball, more crystal clear data, just processed incredibly fast. That makes sense.
Precisely. And, we've seen this in action. Take 2020, right when COVID was starting to hit hard. There were AI tools monitoring Google search trends. They were picking up huge spikes in searches for terms like market crash, layoffs, bankruptcy.
Ah, interesting. So public anxiety showing up in search data.
Exactly. And these tools started flashing red well before the mainstream panic really set in. And the difference was stark. Some hedge funds using these tools, they reacted early, made adjustments. But many retail investors, unfortunately, didn't have that foresight and were caught more flat-footed.
Okay, that's a really powerful example. But it brings up the obvious question for, our listeners. How does the average investor in India actually use this? I mean, most of us don't have a Bloomberg terminal sitting on our desk or, a PhD in Python.
Well, that's the really interesting part now. AI is it's becoming democratized faster than you might think. You don't necessarily need to be a data science whiz anymore to get some of these insights. Our sources actually point to a few specific tools that average Indian investors can start exploring.
Okay, like what?
All right, first up, there's StockEdge. It does sentiment analysis, but it's not just counting good words versus bad words. It's more sophisticated AI looking at news, social media, understanding the nuance of the language.
Okay, so context matters.
Definitely. Then you've got Trendlyne. They offer things like AI-powered stock screeners and scorecards, helps you filter companies based on, well, loads of different AI-driven criteria.
Right. Cut through the noise a bit.
Exactly. And finally, don't overlook Google Trends. It's free. You can literally go on there yourself and monitor search interest for those kinds of market-related terms we just talked about. It gives you a sense of the collective mood, And one of the sources had this great line, you don't need to outsmart the market, just outlearn the crowd. These tools help you do that.
Outlearn the crowd. I like that. So the strategy isn't just picking stocks anymore. It's watching these broader signals. Things like sudden jumps in FII withdrawals. Foreign investors pulling money out fast. That's often a big warning sign.
A classic one, yes.
Or, seeing news sentiment just turn really sour for whole sectors like IT or banking. These are like the early whispers before the big shout happens. And the sources actually sketch out a pretty straightforward AI-assisted strategy you could use. For instance, you could use Trendlyne to maybe shortlist some nifty 50 stocks. India's big players focusing on ones with high promoter holding, where the founders still have skin in the game and strong scorecards.
Good foundation.
Then set up Google alerts, maybe for terms like RBI rate hike, inflation, India, China slowdown, things that could impact the market.
Keeping your ear to the ground digitally.
Yeah. And you could also track sentiment on platforms like Twitter X. There are tools for that like TalkWalker or FinCEN. Some are even accessible.
Yeah.
The idea is if all these different signals, the Trendlyne scores, the Google alerts, this social sentiment, if they all start flashing yellow.
Right. Not just one, but a convergence.
Exactly. Then you'd seriously consider, okay, maybe it's time to hedge a bit, protect your downside. Or maybe book some profits, take some money off the table, or even rotate sectors, moving into something perhaps less exposed.
But, and this is really crucial, AI gives you indicators, not instructions. That's a key distinction.
Ah, okay. Explain that.
Well, you, the investor, you still need to use your own brain, your own judgment, apply your own risk tolerance, your financial goals. Think of it like seeing a storm warning on a weather radar. The radar tells you the storm is coming.
Right, it doesn't tell you whether to board up the windows or evacuate.
Precisely. The AI gives you valuable time, maybe an early warning, but how you use that time, that's what determines your outcome, your returns. It's about informed preparation, not just blindly following an algorithm.
That's a really important point. It's a tool, a powerful one, but still just a tool in your toolkit, not a replacement for thinking. So let's try and boil this down. For listeners trying to make sense of this, what's the kind of the core takeaway, the formula maybe? Okay, here's maybe a simple way to think about it, that Friday formula from the source. First, learn the trends. Use these tools we mentioned to see what the data is saying. Second, lean on the tools. Don't ignore the signals they provide, especially when multiple indicators point the same way. Third, lead with logic. Combine the AI insights with your understanding, your own research, your gut feeling even. And maybe most importantly, always limit your loss before chasing gains. Risk management first.
Absolutely. Because look, another market crash, it really isn't a question of if, it's just a question of when. So the goal shouldn't be to just react when it hits. It's about getting ready now. Don't just react, get ready.
Well said. Get ready. That's the message. By digging into the data, looking at the trends, and hopefully offering some depth, like we try to do here, the Deep Dive aims to ask those questions that maybe help you do just that. Help you prepare. So until next time, stay curious, stay cautious, and stay invested.
If this made you think, imagine where the next question will take you. Subscribe to Stay Curious, because the journey never ends. It only evolves with the next question.